This morning, the conversations we've been having with clients center around this. With markets hitting new highs, what's actually driving it, and does it change anything we should be doing? Last week was a strong one for markets. Both the S&P 500 and NASDAQ reached fresh all-time highs, with the S&P 500 closing above 7,100 for the first time ever, and the NASDAQ putting together its longest winning streak in over 30 years. A big part of that move was driven by optimism around a potential peace deal between the U.S. and Iran. As those headlines improved, stocks moved higher and oil prices came down, which helped support the rally. But as we've seen, the situation can shift quickly. Over the weekend, tensions picked back up, with the U.S. seizing an Iranian cargo ship and Iran stepping away from another round of talks. As a result, markets are reacting this morning with stocks lower and oil prices moving higher once again. So the takeaway here is that while markets responded positively to improving news, the underlying situation is still very fluid, which could mean continued volatility. Looking ahead, focus is starting to shift towards earnings. So far, the start to the first quarter earnings season has been strong, with about 88% of reporting S&P 500 companies beating expectations, which is well above historical averages. We'll hear from several major companies this week, including Tesla, Boeing, and Procter & Gamble, which should give us a better sense of how businesses are navigating the current environment. We'll also be watching retail sales and housing data for additional insight into the strength of the consumer. In times like this, when headlines are changing quickly, it's a good reminder that markets tend to react in the short term, but your financial plan is built for the long term. This is where staying disciplined and properly diversified really matters. As always, if you have any questions about how this impacts your personal plan, don't hesitate to reach out, and we're always happy to talk it through.